So looking at another case study here, we will look at the Casillas family and get into some different complexities when we're talking about married couples and both of them having loans. So the Casillas family is made up of Jose and Sofia. They are residents in California. Jose is 29. Sofia is 27. They have one child who is 3 years old, and they're currently trying or about ready to have their second child. Jose has a DDS, so he is a dentist. And Sofia, she is a medical school graduate. She is in residency, and she is not intending to specialize. She's just going to be a general practitioner. Jose works for the California Department of Corrections currently, which is a public service employer, with a current income of $180,000 a year, but his intent is to start and operate and own his own practice at some point in the future. He thinks that if he does start his own practice, 10 to 15 years after starting that practice, he should be making $300,000 a year between wages and profits. Sofia, she is, as I mentioned, she's a resident at the current time, so she's making $55,000 a year. She anticipates a 3% a year income increase. Once done with her residency and as an attending physician, she expects to be making $250,000 a year, and would likely see that increase up to the $350,000 range by the end of 10 years. With their loans right now, Sofia is currently in medical residency forbearance, so she's just not making payments and allowing interest to accrue. And Jose is currently in a standard 10-year repayment, paying almost $5,000 a month. And they filed an extension, so they have yet to file this year's tax return. In the client meeting, along with collecting all the income and future expectation data for their family, there was also some goals that were discussed. So Sofia is currently pregnant, only a month pregnant, with their child that they expect to have this year. They would like to expand their family, and they'd like to purchase a home or a larger home with their growing family. Medium-term goals, Jose would like to start his practice sometime in the next 5 to 10 years. And Sofia, she would just like to get through residency and get to the point where she is an attending physician and her income increases. Long-term, of course, they want understand that their income is going to be high and they're going to need to look at tax savings. Of course, they want to have a retirement plan in place and kids' college. When talking about these goals, they laughed when they talked about having another child, saying, look, we owe $1 million in student loans and we're looking to have another kid. We're pretty crazy. And it's hard to think about anything other than the debt when they're looking at their short-term goals, purchasing the home, having the family size growing, just the cost burden that they're having on themselves living in a high-income area or a high cost of living area. Medium terms, of course, Jose says, he's hoping to pay off his loans so he can start his own practice. So the reason why he is really buckling down to pay the loans off as quickly as possible is because he sees this as his opportunity to pay the loans off while he has a secure job and then can go ahead and start his practice. Sofia says, I'm just putting my loans into repayment until I'm done with residency. We can't really afford to be making payments on both of these loans at this point in time. And quite honestly, I'm just so busy running around at the hospital and now taking care of a child and pregnant that I just don't think that I can get into a repayment plan right now. Long term, they say, look, we're going to be making $700,000 a year at some point in time. So as our income increases, we have to be smart with what we're doing with our money. We are getting a later start on our incomes because of the professional degrees and towards retirement. So we really need to be smart with our taxes, how we're putting money away. And certainly we want to be smart with what we're doing for our kids because we don't want our kids to have the same debts that we have. So we'll take a look at each one of their loans. We'll start looking at Jose's loans first. You can see he has quite a long list of loans, 14 loans in total. And there are Graduate Plus loans, there are direct loans, there are subsidized and unsubsidized Staffords, both from the direct program and from the Federal Family Education Loan Program. And his loans date all the way back to 2006. The total amount that he owes is $428,728 in principal, and an additional $1,665 in interest. Looking at Sophia's loans, her loans are a little more recent. She began taking out loans in 2008 and completed her education in 2016. And we have a principal balance due of $558,708 with an outstanding interest of $5,887. As you can see, Sophia has completed a direct consolidation. So we have already consolidated all her federal family education loans from previous years into the direct loans program. And we just have those two loans outstanding that she currently has in forbearance. These files of the loans should be accessible to you both in Excel and in sample data download for you to play around with as we move through this case study in the resource section for this lesson. So making some quick observations about their loans. Jose has loans that were issued before October 1st, 2007. Therefore, he's not eligible for the pay-as-you-earn program or the revised pay-as-you-earn program or income contingent repayment. Currently, his loans would only be eligible for income-based repayment. Jose has both direct and field loans. So again, it's going to restrict his eligibility to only income-based repayment for all of his loans at this point in time. Sophia has no loans before October 1st, 2007 and loans after October 1st, 2011. So she is eligible for income contingent repayment, income-based repayment, pay-as-you-earn, and revised pay-as-you-earn. And since she has already done her consolidation, all of those repayment plans would be options for her. The only option or the only repayment plan that would not be an option for her would be the new income-based repayment plan or the income-based repayment plan for new borrowers. So let's jump right into it and give ourselves a little test ourselves as we go through this scenario. Let's say we have a poverty line of $12,000 for one person and $4,000 for each additional family member. And assuming Jose and Sophia decide to file their taxes married joint, let's calculate what their payments would be in revised pay-as-you-earn, and income-based repayment. And then let's talk about what the drawbacks would be for both of them utilizing the revised pay-as-you-earn plan. So take your time, work through the calculations before you get to the next slide where the answers will be there, and then we'll talk about the answers, and then we'll go through step by step some of the considerations and how we came to the answers and conclusions that we did for this case.